Join the Ungovernables. No filters, no apologies. This season, we're cracking open Uniswap governance. Welcome to a new episode of the Ungovernable Podcast.
Welcome to a new episode of the Ungovernable Podcast. Today, I'm joined by Derek, the founder of Steer Protocol. Derek has lived every layer of the Web3 stack and now builds AI-ready liquidity infrastructure across 30 different chains. I'm Austin from Alpha Growth, your premier DeFi operations and growth firm. Derek, thank you so much for joining us. What else should the listeners know about you? I think we might have got you on mute.
Wow, great start. Been in the space since it's a great question. Been in the street about 2016. Started out in wallets, which is really, really exciting. This was before wallets really had multi-chain built into them. You'd have a Litecoin wallet, a Bitcoin wallet, stuff like that. We eventually built out one of the largest multi-chain wallets out there, which eventually got bought out by Voyager Digital. And then I went off to become CTO and build out indexes and big data pipelines, and everything prepped me for what my big build was, what I guess was Steer Protocol, which I'm very proud of. So excited to go through all the stuff we do there.
I love it. And to take us back a little bit further, when was the first time you ever heard about Bitcoin or blockchain, and what was your first interaction with it?
Yeah, it was interesting. So I worked in tech since 2008, and then eventually started working at Capital One, doing some of the stuff there for them there. And that's really when I realized like the intersection of like basically tech and finance. And I was like, wow, these guys are all really rich. I should probably go into this. And that was actually right as I started like learning more about money, and like when you get money in your savings account, they're actually making way more money off of what you're getting in your savings account. And I was like, this seems weird. And then I got introduced to Bitcoin, and I was like telling the guys at Capital One, like, oh, you guys should buy some Bitcoin. They didn't do it. But yeah, that was kind of the first thing. It was around 2016, 2017.
Okay. And then when did you make the jump from traditional finance?
Okay. 2017. Yeah. Basically within 6 months, my friend, it's a funny story. My friend actually, I knew his girlfriend or now wife at the time. And he was like writing on a whiteboard in his car explaining blockchain. I was like, hey, I'd like to talk to that guy. He was working at the wallet company during the ICO boom, and I was hooked, and so I joined them shortly after.
Okay, that's definitely a journey. It sounds like you've hit a lot of different areas in the blockchain space, and it's great to have you on here.
Yeah.
I've seen that you have a background in political science, computer science, and marketing as well. So does any of that cross-pollinate in what you're doing with DeFi today, or kind of really change and guide some of that perspective that you have in the decision-making day-to-day at Steer?
Yeah, that's a great question. I would say not the political science. That did not pay off, but that's okay. You can talk to my dad about that one. But for the computer science, though, of course, I'm a highly technical founder, which is really, really helpful. Just some kind of understanding, what is a fad, what's not a fad. If there's a competitor who's saying they're doing something, how are they probably doing it, and stuff like that. We've also built one of the most advanced and complex SDKs and infrastructure on top of Uniswap right now that people can basically build LP strategies on. Mm-hmm. And I think all of that is just do that technical self. I would say marketing wise though, it's great to understand network effects, and traditional marketing standards and like data driven approaches. That's been huge for us, because if we didn't have that, we'd be probably shooting into the wind. So it's nice to have those backgrounds as a founder and someone trying to lead the company.
Oh no, and I'm sure too, like liquidity, it almost has network effects on its own, right?
That's true.
Rewards to APRs to, do people feel comfortable enough to hop into a new protocol based on the TVL that they have for signaling? So I'm sure that plays a lot into it, not just in the marketing decisions for what you're doing at Steer.
Yeah. It's funny, we touch everybody in the stack, and I don't think I actually understood that when we started Steer. What I really thought I'd be going for is really the end user who would be, providing liquidity on chain, and who wanted an easy way to just set it and forget it. Really is kind of the thing. And then you realize that you're working with asset issuers and all the AMMs, and then you're expanding on to we're at 43 chains right now. I think we support about 50 AMMs. I think we have the largest horizontal deployment of this kind of infrastructure in the industry right now. So yeah, where the places you'll go.
Yeah, and two, do you feel like you work with more institutional players, especially on the liquidity provisioning side, or how do you see? So I think the evolution from, especially your Uni V2, it was pretty easy, hot DeFi summer. Okay, I got asset A and asset B, put them together, throw it in a liquidity pool, forget about it. With concentrated liquidity, you can do so much more. And I'm kind of curious on your perspective, what kind of players are coming into the space as liquidity providers?
Yeah, I would say everybody, I think is more the right answer. So like, let's say you have, I'll go all the way up and down the stack for you, right? Let's say you're just a general user, then you're looking just somewhere to get yield, right? So there's that, right? If you're an AMM, you have markets that need low slippage. You would like people to be able to trade, and it should be a pleasant experience, right? And so for that, you need the ability to kind of like automate the liquidity so it's not stagnant and it's just like a healthy, good looking spot. And then past that, you have the people who are like, issuing those assets on those chains, and you find yourselves helping them. And then on top of that, you're connected to the liquid funds or helping, deploy the liquidity into those markets. So it's really, I would say, just about everybody, I think, ends up needing the infrastructure that we provide. And it's, that's what I was saying. I don't think I really understood the depth of penetration for this kind of need, but especially for end users, they're I think the main benefiter.
Yeah, no, I mean, I feel like that it makes their lives a lot easier, especially with automated liquidity strategies. For our new listeners who may have never LP'd before, how would you explain Steer in like a quick 30 to 60 seconds?
Yeah. So, I mean, I think the biggest thing that actually causes people to leave AMMs is you go to the front page, there's like a farm page or there's a yield page, you click in and there's a bunch of options. You see one that looks nice, you finally get to that page, and then there's a decision that you have to make, which is where do you place the liquidity, at what price ranges? And those are too many mental decisions. And usually people get scared. I don't know, and it's my money. I don't want to lose it, so I'm going to leave. And so what we do basically is saying, okay, let's strip that all away so you don't have to make less decisions. And here's a couple different risk profiles and APRs that match that risk profile. And you can basically decide where you want to go. And then from there, you deposit in our assets, and we kind of take it away. And that's about it. You come back and you can get the yield that you accrued from deploying those assets. The one thing that the alternative would be that you'd have to go every day and have that mental load of determining those ranges and updating that liquidity. And it's just an operational burden. So for us, set up to do this daily thing, you can kind of extract the yield that sits on these chains. For instance, on Polygon, we have like 10% yield on stable sometimes, 6% from us, and 4% I think that comes off of Angle Merkle, which is a rewards platform.
Wow. So it's almost like a user experience layer, an abstraction layer for those that want to provide liquidity into any DEX, really.
Any DEX, any chain is kind of the goal. So just think of a DEX. We support about 50 DEXs, if not more now, across 43 chains. So if it's EVM based, you'll hopefully find us there. And if you don't, let us know.
Yeah, and so I feel like that's got to be difficult to just maintenance wise. 30 different chains, 50 different AMMs. What's kind of the hardest part for this omni-chain infrastructure?
That's a really good question. We have a very large node infrastructure. Steer built itself as an off-chain compute network first. That was kind of the weird thing that we did. Eventually, we brought in our first product on top of the infrastructure, which was our ALM product. There's others, but basically, I think the biggest win was understanding multi-chain networks prior to coming into Steer. I had built out a brokerage, I had built out a wallet, I had built out multi-chain AMMs. So at this point, it was like, okay, we have to be multi-chain day one. And once we did the first deployment, it was like, how fast can we do the second? Luckily, a lot of our stuff is automated and pretty on chain. But for everything else, it's really just making sure that there's alerts and making sure everything's kind of automated, which Steer automates things. So what better way to do it than with your own tools? Yeah,
exactly. So okay, you said Steer, the ALM portion wasn't the first piece. Can you talk a little bit more about?
Yeah, we built. So the idea of Steer originally was any chain, any action, any data. And that's where actually that has made us one of the better ALMs. Is if we have a strategy that we launch, for instance, on Base, we can take it to all 43 chains at the same time. Each chain has different data sets that they need to connect to, different data feeds, just different needs. And so we have this data connector marketplace. There's over I think 250 different data connections that we can interchange within every different strategy to help it, just work on those other chains. So when someone builds on us, you kind of build for everything.
Okay. So essentially you really built this first piece as almost like a way to automate different strategies or create structured products. And then you got into the DEX or the AMM side of that with Steer. Is that, do I have
with
that right?
The ALM product? Yeah.
ALM.
Yeah.
Okay.
Yeah, that's correct. We were originally incubated by Uniswap, so there was a little bit of a nudge in that direction. But since then have grown to support, tons of chains, tons of DEXs.
Yeah. So have you grown into other facets, like let's say like options engine, perps trading? Is it the primary focus with the AMMs, or are you growing in any other direction as well?
Yeah. I mean, the biggest one is incentives and lockups. I mean, that's just the second thing that came, right? It's like, hey, now that we have these things, we should incentivize them. So we have a fair share of robust infrastructure for incentivizing or helping teams who have V33 DEXs to distribute those rewards back to those users. And then past that, for options, we actually are just wrapping up audits right now with a partner called Strike, who enables options on top of V3 liquidity. So right now, when a team comes to us or a partner comes to us, or even a user, because we're permissionless, comes to us, when they set something up, it's always a spot market. And soon you'll be able to do spot and options with the same amount of money. It'll be really, really exciting to hopefully start having these options markets on really any asset on any chain. We'll see how that kind of blossoms and see how that goes.
Yeah, it sounds like really an all-in-one hub to get everything set up. I'm kind of curious too, are you hand-holding people to create these strategies, or are you more providing that infrastructure to let people create those strategies?
We're uniquely the only permissionless ALM in the industry. Everybody else, usually you have to go through some sales process. You can go to the app today. There's actually a quick mode, or there's a more advanced mode, but anyone can do it. Some teams will reach out to us, say, hey, what do you think is best? Or, help me with this tool. But for the most part, we try and be as permissionless as possible. So we have about 20 different strategies that you can start using in under about 30 seconds. That would be the.
Oh, wow. And what kind of strategies would those be? Are there any
Sure. Yeah. For us, it's there's so many. So it's if you're doing let's say you have a certain amount of assets and you want to TWAP out or in, you could use a more of a treasury based strategy. If you're doing an LST, we have strategies where, because one of the assets is kind of gaining accumulation of yield, so it's kind of got this positive skew, we'll build limit orders to kind of chip away and gain more of the LST over time. We have stable strategies that do a bell-shaped curve, which are really, really good. That's why I think we have some of the best stable yield on AMMs right now. And the list kind of goes on. And it depends really on what you're looking for. Some people really don't want impermanent loss, right? So they'll say, hey, on this side of the asset, can you help me out? And then on the other side, I'll tighten up. I want to get some fees. So we'll do directional and permanent loss. We can't get rid of it. That's not a claim. Can't get rid of it. It's still there. It's just we try and minimize that in a directional sense. And those can also be helpful for people who want to keep more of a ratio.
Okay. If you had to recommend to somebody a strategy that they might want to start with, a quick one to test out Steer, what would you
I think it's the tried and true. It's a tried and true channel multiplier. It's our quick mode version. It's the least amount of options, questions for you to fill out. It's how wide would you like to go? And so do you want 5%, 10%, 20% around the current price? And I think the best rule of thumb is the wider you go, the safer you are. And so I always tell teams go as wide as the thing will let you. For people who really want to put risk and really soak up maybe some APRs, then you can go for something lower. But I just always give people a general thumb is wider is actually better in these senses.
Okay. Yeah, and that makes sense. And that's due to the fact that
It's a very easy example. Okay, so you have Ethereum and I have USDC, right? And Ethereum's going up and you're feeling great about it, but I'm feeling kind of down about it because Ethereum's going up. I have USDC, so I'm going to buy some Ethereum from you, right? And Ethereum's still going up, but now you have less Ethereum, so you're a little bummed now, right? But I'm feeling good. That's a permanent loss, right? It could be that the price comes back down and maybe I give it back to you, but you're losing it for a little bit of time. And it could be that when you come back, it's actually gone. That's why it's impermanent until it's realized. And so if you can always make sure that you're in range and that you're not giving away anything that you don't want to too fast, then yeah, that's kind of the goal. So that's why I always say wider is always better, because you're giving it away slower than a person who's tightened it up and is giving it away super fast.
Oh yeah, and I feel like with the past couple of weeks too, the market movement, it's like, okay, if you had a tight range, you're going to end up on one side or the other.
Horrible experience, right? And so that's not the first experience you want anyone to have, right? You just want it to be where they come back and they're happy, stuff like that. So that's why I say, yeah, wider is always better.
Yeah. And so I believe you have one thing I was seeing is a smart launch feature. Could you maybe walk us through what that is and what that flow is from a user perspective?
Yeah, so this comes out of talking with a lot of partners. So we work with IDOs, we work with AMMs, and the biggest thing is if you have a token that you're launching, you really haven't thought it. You've been building something else maybe, and the token is something that's supplementing it. Unless you're a meme coin, that's all it is, right? But eventually, though, you need to do something else with that token, or that token needs a better market, or whatever it might be. A lot of times, even the simple create pool flow for users is very scary, right? It's just an experience that, like, I don't know, it's just daunting. It's like a tax form. It's like, if you get this wrong, you're messing it up, right? And so what we basically said is, okay, let's stop doing that. There's also some people, who you see, they go live and then they get botted or they get sniped, or there's some kind of miscalculation or whatever it might be, right? So what we said is, okay, let's help them do the create flow. That's the AMM side. And we'll also bundle that flow with the ability to pick like pre-selected strategies, and not just one, but like multiple diversified risk profiles for your LP that goes in as like the initial launch liquidity. And that's all basically bundled up into one little UI. Sometimes if it's like an unpriced asset and you're going to do it against ETH, we'll do like 3-way price or 4-way price conversion against some of our pricing APIs to help you. Like, another problem is like, let's say you're going to do launching a pool called Austin token, right, against Ethereum. You need to figure out what that ratio is to set the initial ratio. That's kind of the scariest part. And being able to do it in dollars, which is usually how people think, is just much better experience. And so we kind of help people do the conversion automatically for assets that don't exist, because you're going through a create flow.
Yeah, that makes absolute sense. And I know from like back in early days, it's like one extra zero and you've messed up your whole token launch.
And that's the sad part. Yeah, there's no take backsies, right? So if you launch it at the wrong price and someone bots you and buys a good amount of your supply, or it's just and a lot of people are building other products, right? They're building a whatever it is, right? And they don't understand this part of and that's okay, right? But people need tools so that they are more de-risked as they go into these decisions, basically.
Yeah. How do you protect from like bots or being sniped from initial liquidity? I think that's always something that's interested me, and I just never understood how.
Each chain is different. Sometimes they're kind of non-existent because it's a newer chain and people just aren't botting in that sense. We do have the ability to do dynamic fees, which is really cool. This is more of a V4 hook actually than anything, but basically allows you to do like a Meteora style token launch with these, gated, time-weighted fee tiers, which is really the biggest thing. Is if you minimize or maximize the economic risk for the person who's buying with an 80% slippage, then they're probably not going to buy tremendous amounts. And it allows the flow to kind of like naturally come into the market versus just an onslaught of potential buys and sells.
That makes a lot of sense too. Because if you have so much risk on, it's going to be somebody that's probably part of the group that's going to want to buy early rather than an outsider seeing a random liquidity pool pop up.
Correct. And it's like as it comes down, those people probably come in more than somebody who's just trying to come in and get out quickly. You're going to take 20% risk. You're going to take 30% risk. Like that's silly. You're probably not. So yeah.
No, it makes sense. It makes sense. And I wanted to touch on, I think you guys were doing some very interesting stuff with the AI agent and kind of AI liquidity provisioning or automating liquidity management. Could you speak a little bit to that?
Yeah, those are actually, that's pretty interesting. Those are very interesting vaults. I will say that. There was a vault that we actually just had to reach out to one of our partners about, and we had to recheck the APRs because it was just doing so well. But basically what we've done is we've worked with a team called Allura and another team called BitTensor to basically bring in their AI data feeds. So we have that data marketplace I talked about, the compute network and all that other stuff right to the side. But that allows us to basically pull in both on-chain data as well as off-chain data as we run more data-intensive algorithms that you normally run on-chain, which is why our strategies are very, very advanced. And so for Allura, we'll bring in their data feeds. And so what Allura basically does is they'll run like 10 to 20 different AI models to predict the price, let's say, of like USD and ETH. And then they'll do an ensemble model, which basically determines how well each model's doing and gives you a composite of like the best predicted value. So you're like basically taking 20 models and getting one nicely, groomed up value. And that's what we go on chain with.
Okay. So you don't have these live models.
No, they're live right now.
Well, so is the models in each ensemble live on chain, or do you only do historical data? Gotcha.
So this will be off chain on the Allura network. We'll grab that from the Allura network, and then it gives us an 8-hour prediction. We can do a 4-hour, a 1 hour, but we usually go off the 8-hour. Just what we do. And that basically said, and we'll do a 4-hour rebalance. So every 4 hours, we rebalance to the predicted price in 8 hours. And what ends up happening is majority of the time it's kind of right. And so you're basically saying, I'm going to sell you my stuff where it's more expensive, like a lot of times, all the time.
Yep.
And they end up just kind of accruing the underlying assets. And because they're just kind of ahead of what the predicted values are going to be. So they're very, very interesting strategies. And some of our strategies are very they're kind of gradual. They don't kind of like spike around or something like that. But when you deploy these like predictive values, you find that the strategies actually end up very, very choppy because they're making these like very, interesting decisions.
So what do you, for these on-chain markets and liquidity markets, what do you see are the primary use cases for AI to get really involved here, and who are the end users
of these types of models?
These models are like the AI liquidity management or the ensemble
algorithmic liquidity management in a whole.
Yes.
I would say the end user is it starts with who's issuing the asset, right? And do I have the ability to even have the tools like this to get on chain? But I guess that might be first user, maybe not end user. So the end user would probably be the communities, right? It gives everybody liquidity depth. It gives you the ability to know that if I need to sell $1,000 of some token, that there's $1,000 that I can sell without massive slippage, right? That's kind of the biggest problem for a lot of long tail assets. Usually what happens is you'll have people who can go to an ALM that's not us, who's not permissionless, right? And it'll take them a fair share of means to get that stuff off the ground. And so most of these long tail assets don't even have, on-chain infrastructure to make sure that their markets are healthy. And so the communities really do suffer because they have these assets that they can't trade, right? And that just kind of stifles the entire thing.
Okay. Yeah. I mean, that makes a lot more sense there for, I guess, long-term vision, because I feel like AI is relatively new, especially in the automated liquidity management space. Where do you see us going in the future of AI liquidity management? Is this one of those things where it's like, I have one token, I have USDC, and I'm just like, hey, go figure it out. I just want to know I'm going to have USDC back? Or how do you kind of see that the automation piece as well as the AI piece start to improve and take over more of this space?
Yeah, I mean, I think we were doing I'll call it algorithmic strategies, right, for the past couple of years until Allura and BitTensor came around, which allowed us to bring in these dynamic outsourced, models, which is huge. But I think to your point, and I agree with this, is that there's really no way to say, okay, well, maybe I shouldn't be LPing Ethereum right now. I should be LPing Bitcoin, or I should just not even be LPing that at all. I should just be in stables or LSTs or something like that.
Yeah.
That's another mental load that users don't want to know, right? They just don't, right? And it would be so much better if Allura had like an ensemble of that, right? And we could go for that one. But yeah, right. We have a product called Toro, and if you're clever enough, you'll find the domain. And it basically allows you. It's alpha. Don't put major money in there. Basically allows you to automate. So we have all these data sets, we have all these strategies, we have all of the different dexes and chains that we're on. So we actually have a fair share of infrastructure that's just sitting there within our system. We basically connected it as like MCP tools within a user interface. So you can connect a smart account wallet, log in with your Google account or your Face or your MetaMask or whatever, and basically delegate out different tasks like LPing. It can run our strategies in the browser locally, so you can actually go deploy and do stuff. So it's very cool. But I think the biggest thing is that even past that, people don't even want that, right? They just want to be able to say, I want my USDC in this thing, and it should come back with more money at the end.
That's kind of funny. I feel like people just want to have things super simple, like
Right.
a limited amount of options. They don't want to have the decision fatigue. And if they can put asset in, get a certain APR out, they're happy with it. And
Right.
Oftentimes I feel like a lot of like the retail users don't even check what APR they're really getting at the end of the day.
Yeah. I think the biggest thing for LPing is more risk profile. It's like, do you know what you're getting, like the risk that you're getting yourself into when you do this? Some of them are riskier than others, right? And some you could make a ton of fees. Sometimes you could not. And I think knowing that, getting into it is just giving people a better chance of doing it more.
Do you believe that humans will always be involved on the risk side? Or are we
No way. It can't be that way, right? Like, it means it's kind of silly. Although I will say that like there's like the intuitive approach, right? Of like, hey, I know that Tesla's going to go up in a year from now, so I'm going to put it part of my portfolio, right? And then there's the programmatic approach that might not see that Tesla's going to go up or hold it due to whatever signal that comes in. And who knows what will win. But I would say AI gets us a little closer to figuring out what that might be versus running both and not knowing.
Yeah, or we just end up using AI every day, and then our brain rots, and we don't have the capacity to make decisions.
Talking to it all the time. I don't want to be talking to an AI all the time. We got to get out of that mode. I love it how it's working right now, but it's just like I feel like this is like the intermediary to like probably what we end up doing, because it just seems kind of silly right now.
Yeah,
it's like emailing yourself. It's like.
Oh yeah, exactly. It's like, okay, you're not even allowing the capacity to let yourself sit there and mull over something, or you have to constantly figure out how AI can think for you rather than you think for yourself.
Correct.
So that's I'm sure we could go down a pretty deep rabbit hole there. But I want to know from you, Derek, what are you most excited about for Steer and what's coming up with Steer?
Yeah, we have a bunch of really exciting chain launches right now. Just launched on Peak Chain, so a machine-based peer-to-peer payments chain. There's Oku over there as well. So those who love the Oku experience for Uniswap, come check us out. We also are launching on Saga Chain, I would say probably in the next 2 weeks, with support there. So if you are, again, an Oku user, we'd love to see you. We can help you out over there. We are going to be launching on Ronin Chain, I believe, also in about a month. So really excited to be part of that. And basically every month or every week, we have some kind of yield program running across our partners. So if you have assets in your wallet, which you're looking for yield, we definitely have a home for them. Depending on your risk profile, there should be a bunch of different options for you. My general preference, if you're going at it alone through our permissionless system, wider is always better. And then once you get comfortable, it's not too bad to learn. So excited to see you.
No, I love that. A lot of exciting stuff coming up, and definitely to remember to go wide before you go narrow. I wanted to dive in a little bit with you, Derek, on the Uniswap side. So how is Steer integrated with Uniswap, first off?
Sure. So we support Uniswap on every chain, I believe that they're on, currently on every V3 deployment out there, as well as all the Oku chains as well. So we're the widest, I think, deployment of ALMs in the space. Supported them, supported Uniswap for, I guess, maybe 2.5, 3 years now on the ALM side. And really excited to be also day one partners over on Unichain. We have 3 hooks that we've developed, most of them currently on audit, but we have some work that we've done to enable KYC AML pools for more enterprise customers through Coinbase and Kraken, which is really, really exciting for people who have like Coinbase One accounts and stuff like that. You'll be able to get access to those liquidity. And then we also have the ability for you to provide tail of the assets. When you LP, one of the biggest things is it would be great if the liquidity that's inactive would be active elsewhere, maybe in lending markets, maybe in bridge networks and stuff like that. And so what we allow people to do is connect the traditional LP experience with additional yield sources that are generating other types of things for tokens. So tokens have issues potentially getting bridge liquidity or sometimes having lending markets. And so you can basically connect those markets to the back ends of your AMM pools and basically get, the best of both worlds. So you pick the ratio of, how you want the money to go. And when the dollar comes in, we'll break it apart and we'll place it basically into those 2 places. I mean, that basically just frees up, which usually is inactive liquidity, into those other yield sources.
Okay. And so, you said KYC pools, and this one is more of like rehypothecation.
We're not looping. I mean, that backend strategy could be, hopefully not, but just for, the goodness sake. But basically, you're able to connect 4626 strategies to the tails of the liquidity position. So let's say a strategy runs off chain and says, hey, let's go 20 wide. It will basically chop off some of the ends and go put them in those vaults. And that just allows for traditional, just an additional yield source, but also for protocols and asset issuers, the ability to kind of spin up those secondary markets. It's very hard. Let's say you want to do a lending market. It's hard enough to get your liquidity for your DEX. You have to do the same thing for lending. So this allows you to kind of do both at the same time.
Oh, wow. So what use cases are you most excited for with that? Because it sounds like you can do a lot more than just park it into a lending market.
Yeah. We've had a couple of people come out to us and basically look for looping, I think is the biggest one. Some are trying to basically use it for options liquidity as well. So basically take it from a steer strategy that's maybe for a spot market and then reuse some of that to go enable a options market or basically provide liquidity for liquidations. That's another big one. If there's an asset that has a lending market, there needs to be like a depth enough within the AMM market so there can be like an efficient liquidation. So you can basically help kind of break some of those edges over and give you a little bit more depth to help in those scenarios as well.
Okay, that's super exciting. I feel like we're just starting to see a lot of these use cases for V4 hooks start to come out. I think a lot was vanilla, and now we're really starting to see these very interesting use cases as you're talking about with the rehab or multiple rehypothecation to really utilize that liquidity completely
and really start doing something with it, right? And I think the expressiveness of the hooks is really what gives this developers the power.
Yeah, and how do these like V4 hooks play into your other strategies for steer?
Yeah, that's a big one. So one thing I realized when we built the hooks, it was like, oh, we still need the ALM. It's like you still do.
That doesn't go away.
No, it doesn't go away because there's other strategies, right? You need external data sources, and you need the ability to just do some compute, and that just doesn't exist on chain. So for a lot of the stuff for our hooks, it's the same ALM setup where you can do kind of like any curvature into a market. So we kind of curve the liquidity, but it updates every swap. So our ALM doesn't have to be there to basically be the back end, which it currently is for V3. So it actually makes all the markets that we do much more efficient.
Wow, that's awesome. So I guess I want to ask, if Uniswap were to introduce hook level fees, how would this impact steer and the strategy economics there?
Oh, are they thinking about doing that? No, I'm just kidding. That's interesting. I will say that a lot of times, a lot of people like dynamic fees. I think that's a very popular topic for a lot of people who look at AMMs, right?
Okay.
Dynamic fees to me are not good. They just aren't good. I
Oh,
feel like if
really?
you're in a stable pool and there's a fee that's 0.0001, that's crazy. It just makes no sense. Where are you going to make the money? There's no money to be made to put your money in a USDC pool if eventually the fee's so low that you might as well put it into lending versus the AMM, because it just doesn't make sense. You're just giving it away. Because I mean, one very spicy topic right now, which I don't even want to enter myself into the ring. I don't. So that's not what I'm doing here. So who hears this? But right now, I think some guy from Fluid, I think one of the founders from Fluid, said something about Bunny Finance, and about Bunny has this pool right now that has a geometric curve, which is a bell-shaped curve, where the fee is set to like 0.00004 or something like that. It's just like an astronomically small number. And so they've done a lot of volume. I think they've done like 28 million of volume or something like that. I saw, or maybe double that. I forgot the number, but they've only made like $40 in fees. So it's like to the end user, what are you really helping with here? That's not a conducive environment. It's just like you're just getting volume, but for what? Right? So dynamic fees are just a weird environment. I think having those static fees also gives the users the ability to say, okay, when I route through this pool, I know that I'm getting a route with this kind of fee. If an additional fee comes on top of, just real quick, if an additional fee comes on top of dynamic fees, you're taking a sub penny out of a sub penny. It doesn't make sense.
I see where you're coming from. Maybe you could school me on this, because from my understanding, dynamic fees were to help with impermanent loss. So if the market's moving in one particular direction pretty quickly, you're not able to rebalance or move those positions seamlessly. You're making enough fees that, hey, it's okay that you aren't capturing that value in other ways. So it's protecting against impermanent loss. I kind of see what you're saying, but I would love to hear your take on that, and then I'll have another point.
Sure. I mean, fees never account for permanent loss. They just won't, right? So like you're going to sell one asset, right? Let's say you say a one within a range, right? The fees that you make are not the whole, never the whole. Because when I do a swap, it's always a portion of my swap, right? So like a directional fee, right, even for an IL perspective, is never going to pay off the IL. So you're just kind of like maybe helping the situation, but only if there's like really good volume. See what I'm saying? It's just it might not actually do like as much damage to the actual damage that's been done, kind of thing. It might not help as much as we think. I mean, I know that there's studies and they've done the math. I've seen the charts, but I've lived it, and I just don't know about that.
Well, and I guess I see the economics behind it too, right? If you're the lowest one, you're going to get most of the volume, but as soon as you're above that different pool, the threshold, the pool that doesn't have dynamic fees, they're going to capture all the volume. So you're only capturing enough volume and really hurting everybody else for fees, and not so much capturing more fees than everybody else.
Than everyone else. Exactly. Yeah. And that's why everyone makes less money on these dynamic fees. And but the thing is, like, it's really the LPers who need to make the money, so they keep LPing, or they're not going to LP.
So how do we?
But then you have Uniswap X, right, which sometimes fills with other pools that aren't the LP pools of Uniswap on the chain. That's not cool, right? Yeah. Like if I'm an LPer, I don't want to be the last person that's used. I want to be the first person that's used, and that's the same dynamic fee problem, where it's like I don't want to make less money. I want to hopefully make a little bit more money, because everyone says LPing's hard. Everyone says LPs lose money. Right? Everyone's like always down on LPs. It's just like, well, don't hurt the situation. Like, help these guys make more money.
How can we do that? Because I feel like it's a slippery slope, right? If LPs aren't making money, then that hurts the rest of DeFi. You can't have as high of caps in lending markets. The other markets within the DeFi ecosystem aren't going to be as effective because you have such low liquidity, or they have higher risk now because you can have larger, bad actors coming into the space and damaging some of these different protocols. So how can we help liquidity providers make more money?
Yeah, I don't know. I'm trying to solve it. I think the biggest thing is the way that we do. And I think one is like the strategies that have the impermanent loss kind of inside its mind, where it's like, okay, the asset's going up, I shouldn't be selling it as fast, right? That's the biggest one. It's like, let's widen the range if it's going in a direction where I think, like if it's USDC ETH and ETH is going up, let's sell ETH slower, right? Let's not give it away so fast. That I think is the biggest one for people, because if you can like minimize to a point some part of the IL that way, that's more material than the dynamic fee that you were talking about, for sure, 100%. Then the second one is like this incentive wheel that we're all on is horrible. And it started in 2017 when I joined, and we're still doing it. And I've just accepted it. I think everyone else has accepted it. It's terrible though. Like, why are we doing this? So we have a product called Smart Bonds, which allows protocols basically to say, hey, look, I have a governance token. If you have $1 of liquidity, I'll give you $1.05, right? And so after I'm done renting this liquidity, which is what's being done right now, you'll end up actually with some liquidity within your treasury. So then you can maybe narrow those ranges. You can take that risk, right? You can go, do whatever it is to hopefully support that liquidity structure within your market. Versus right now, they stop doing the incentives and it goes away. And so more incentives get poured on. And now it's an incentive war between protocols, right? So I think it's letting people get off that hamster wheel is one part of it. And the second one is trying to help LPs with like better strategies than like a 50-50 mix, up and down. That's not the strategy for sure.
It's very much game theory. If one chain, one protocol is doing incentives, then everybody else is losing.
Yeah.
So it's like we all have to stop at the same time.
Yeah. And you see it with a lot of L2s, right? A lot of L2s TVL graphs are like bell-shaped curves, right? And there should be less of that, right? And so how do you kind of have that everlasting liquidity on those chains versus letting it all drain out?
Yeah. Okay. I appreciate that. I wanted to touch back on like the V4 hook building process. What were some of the underutilized resources you're like, wow, I really wish I would have known this at the beginning from that? And then also, what do you feel like is missing to really help builders build cool V4 hook projects for the next killer app?
That's a good question. There is there's like the V4 hook DeFi dojo. I would say it's a Telegram group. I'm not too sure how I got added to it, but I'm really happy I did. It's a lot of DeFi V4 hook builders, basically talking about V4 hooks. If you follow me on Twitter, I will find out after the show, and then I will tell you on Twitter somehow how to get there. Perfect. But basically, very, very good resource. So if you have an issue on V4 hook development, there's Uniswap guys in there. There's other supportive teams that also worked on V4 hooks who are willing to answer your questions. I think that really is like a treasure trove of just like real people that you can go talk to and get support. So that right there, I think, is number one. Number two is there are a fair share of GitHub repos out there that have shown off, here's some examples. The examples are okay. I would say the best bet is you really got to dive into the Uniswap code. Biggest information is that the docs don't say everything, but the code does. So go read the code. Don't rely on the docs.
That's fair. That's fair. What do you feel like might be missing to help these V4 hooks projects grow? Could it be, repository of different V4 hooks, or like a separate front end that showcases these V4 hooks? Like, what do you feel like would be a great way to help some of these projects grow?
I will say that we're in development. We have not listed on the Uniswap UI. So a lot of the stuff is basically in audit or in preps for audit. But from what I've seen so far, is the biggest thing is once you get done with your hook, the ability to get listed within routing is the biggest challenge, right? Because if you don't do that, you're really not going to get any flow. And so the biggest thing I would say or the biggest challenge, right, is that for a lot of teams. And I feel like finding a way to get it permissionless or democratize it some way better, right? So it's just less of a burden maybe on the foundation or the labs. I'm not too sure who deals with it, but I know that that's been a kind of a struggle for some of the other protocols. And I think solving that for the next people who come on board, I think is the next step, just because it just allows for flow to start hitting those hooks.
Oh yeah, exactly. And how do you, because I know there's been one vulnerability with one V4 hook. How would, if you were in Uniswap shoes, how would you
deal with that?
Straddle that balance? Because you want to have,
they have say they do have the Uniswap security fund, which you can apply to. It's a monthly occurrence. You can apply through it. It's managed by a company called Areta. And they provide audits for hooks basically. And it's there's a verified vendor list for V4 hook auditors. I've talked to a fair share of them, and they're all actually pretty good. Some really understand V4 hooks. One of those is Balasec. Those guys over there, I sent them our code, and they're just like, wow, we can go through all of this, and they really had very valuable pieces of information they could share right off the cuff. So I think for Uniswap, they already have a really good security fund. I have heard that they're also doing potentially secondary reviews just in their core team before they let hooks go live, because I think Cork happened and the other protocol happened, and they were kind of let's see if we can just tighten the hatches. So I think from what I'm hearing, they're doing all the right things, right? So yeah, but I will say audits are never a silver bullet. That's the kind of the hardship of an audit. It's a very expensive thing to do, and once you get it, you never know if it's if it's fail safe. So it's a tough one. I will say that our protocol has worked with Nexus Mutual and Open Cover, so you can buy insurance on any of the assets that sit within Steer. That would be for contract risk for any of our contracts. I think that's there needs to be a solution, right? So if that's the problem, right, what's the solution, right? So you can buy insurance on certain contracts. And I know that a lot of insurance providers would back a hack of Uniswap or something like that if you were to go buy coverage there. So
no, I feel like that's a great solution, or even a open bug bounty for different V4 projects where you have people actively double checking constantly, because things are going to be evolving, the markets are going to be evolving, all these different integrations, and it's going to be hard to cover all your bases and expect no vulnerabilities to come through.
Correct.
You're really only as strong as your weakest link. And when it comes to having people build on top of you, it's just something that's hard to contain. So totally get it from the side of hey, let's wait to turn the switch on in terms of routing.
Yeah.
But I think a lot of V4 projects have been asking.
I see what you're saying now. That's a fair statement. Yeah, I don't know the solution there. I just feel like that if you pass a certain test, you should just get listed, basically. It's kind of the thing. For Uniswap, the big thing for Uniswap V2 and V3 and V4, right, is that any asset can list and they're live, right? It was the permissionless of Uniswap, which made it so beautiful. Right. So you can't have a permission system for developers to onboard themselves as developers onto your expressive network. Right. That's a tough one. Right. Because now there's a worse process for builders than there is for asset issuers.
Yeah, that makes it tough. Because if you really want to be more of an infrastructure product rather than a DEX, you have to, lose a little bit of control.
That's what I'm saying. I think there should be a standard, right? There should be audits. There should be a fair share of stuff. But I feel like eventually you have to kind of let them go.
It's kind of like, Apple in the App Store, right? If you check all these boxes, you're on, and then it's almost, hey, we're hands-off liability.
And it's not like it's Uniswap's fault if a Uniswap pool was hacked, right? With a hook in it. That's not Uniswap's fault. Yeah. It's just not, right? So
it's like blaming Ethereum for a hack on mainnet.
Yeah. So it's an unfortunate event. No one should ever get hacked. That's the worst, right? But yeah.
No, it makes sense. And Derek, I'm kind of curious, do you participate in governance at all? Because I feel like, you have all these relationships with different blockchain networks, different DEXs, AMMs, different protocols. I feel like that would just be something that, Steer yourself would be participating in, but I don't know if you have enough time to be doing that.
I don't. I always, it'll be every quarter, I'll think to myself okay, let's get into some governance. I just haven't done it. We've done some for Arbitrum. That was really good for us. Usually we are part of other people's DAO proposals, just as a back, we're part of the engine or something like that. But no, I don't. If you go to you won't see Derek as this active voice in the governance, but I should be. And so maybe I need to be.
Do you feel that V4 projects should have an active voice in the DAO?
Oh, in the DAO?
Yeah, for Uniswap DAO.
Oh, that's a weird one. I mean, no, probably not.
Okay. And why is that? I'm just curious.
Just because I don't know if I should be controlling any of those decisions. Right. Or I mean, I understand that it's a DAO. I understand that. Right. But if you open that door, a lot of people will be selfish about it. They're oh, well, then I'm going to push this, this is what it's going to be. I'm going to, king make myself or whatever it might be. And by not allowing that door to be open, it allows them to just not have that influence. And I think that that's kind of better than having potentially like this lobbying policy that could maybe get you into like certain, voting patterns.
That's fair. That's fair. Yeah, it could be very easy to collaborate amongst V4 projects, and that's kind of like giving Apple stock to app stores.
Yeah.
Apps on
Yeah, it's like, yeah. I mean, I don't like, I think you could do fee revenue shares. You could do a bunch of other things, but to allow them to, I guess I would say that the Apple fee would have been brought down a lot faster. So
yeah, that's true.
Yeah, maybe never mind.
Okay, so maybe I want to touch on treasury aspect. You brought up smart bonds. I think that's a very interesting model with protocol owned liquidity being something that either DAOs or treasuries or liquidity providers can really focus on to or protocols themselves to really focus on to get that liquidity rather than incentivizing it. How do you think the Uniswap DAO could possibly leverage this?
Oh, sure. I mean, look at Unichain right now, right? I mean, a lot of people are talking about the massive incentives that are going on there, right? And the sustainability of it. And we're on like 43 chains. So we've seen the life cycle of chains over and over again. And there's a certain life cycle that happens depending on each decision puts you on a different path, but eventually there's like a certain path these people go on, or these chains go on. And I think the biggest thing is if you have a lot of volume and you have a lot of people active in your community, you should try and acquire some of that. If you look at like Polygon, they have a new chain called Katana, right? Well, even prior to that, you had Berachain, and before that, you had Blast. But the idea basically was that the V3 style situation, give ownership to the users to be able to vote, and then let's also try and have some chain on liquidity or some like pre-deposits or something like that allows you to have some kind of just like POL or protocol owned liquidity. Some call it POL, some call it COL or chain owned for Katana. That is pretty good because you know that liquidity is going to be there after the hype cycle, right? And for Uniswap, I think the biggest thing for them is, if you use smart bonds, right? Or you were to use your assets to maybe pair with other assets. And then if those assets go, in certain directions, you could then, I don't know, do buybacks or whatever it might be. That allows you to start accumulating treasury and stuff like that versus right now, I would hate where the incentives end and there's nothing to like that they haven't accumulated some of the underlying LP, right? Like if they're doing massive amount of incentives, like you're telling me that at the end of the month, you don't have at least $1 million of LP, which you've accrued from those incentives, right?
Yeah.
Because if you don't, then they're just going to leave when those incentives leave, right? So that's my biggest worry, and I'm sure they'll think of a solution there, or they can come talk to us. But that I think is the biggest thing. Is like, how do you make sure there's sustainable liquidity after these incentives run out?
Yeah, I think a lot of chains have seen this problem happen where it's like, okay, we're going to release these incentives, and then once you turn off the faucet, everything leaves. So, especially with the Uniswap treasury too, you're really the only token that's in there is Uni. So how can you start to diversify a little bit and have your own protocol liquidity for Unichain and then be able to park that? I think that's a very interesting solution. It's been
a weird dynamic for a lot of years because a lot of AMMs have had their own token and had to incentivize teams away from Uniswap, right? Because Uniswap's always been the purest and cleanest, place to launch. Whereas if you look at like another AMM, they're going to give you 20% incentive boost from their own native token. And it's just this very competitive nature of like, okay, well, there's another AMM. It's going to give you 25% if you list on them. And it's just like, oh, geez, Louise. But Uniswap has always had that like, well, I should probably go Uniswap before I really think of other ones just because of that brand equity that comes along.
Oh yeah, it's a place to be. People know how to use it. They're not afraid to be able to swap their token and get
or there's a contract change or something like that. Yeah,
exactly.
Right.
Okay. Well, I want to ask a couple more questions, Derek. I appreciate everything that you've gone through so far. I want to look at like Steer's future vision. Let's say we're in 2027. What KPI are you guys shooting for? And what's if you had a magic wand, what's going to be happening for Steer in 2027?
Sure, that's interesting. I think the biggest thing that we found is we started with spot markets. We started to dabble in options, so that's going to come live soon. We started helping with a bunch of ETF products on chain, so different like baskets and stuff like that. So Reserve Protocol, I think, is the biggest one on Base that we currently work with. There's a Clanker index that you can go check out for the Clanker guys who are into Base. And another one for like Altcoinist, and there's the Bloomberg 30 and stuff like that. So those are like real indexes that have been licensed by Reserve. Those are interesting. And so there's these traditional style infrastructure pieces that are starting to look like the traditional world, right? Of like traditional finance. We already see it with the options that we're doing right now. The ETFs we helped out with around ETH Denver this past year. So that was rather interesting launch because we launched like 47 individual market strategies before that launch. So we work with all the underlying asset markets as well as the actual like index market itself to help that on Uni, which is kind of cool. And so I think for us, it's really trying to bridge that gap. When you kind of see that with our Coinbase, AML pools and the Kraken stuff, and trying to bridge and say, okay, there's a lot of traditional assets out there that need to come on chain, right? They don't have any tools. They don't have the ability to take it out of the qualified custodian on chain without like losing chain, custodial command. So all of that stuff needs to be like basically figured out. And luckily we were on enough chains and stuff that we can, talk to enough people and kind of figure out how that's done. So for us, kind of bridge that gap and hopefully be the backbone liquidity layer for most the blockchain industry. Let's see.
Yeah, bridging the gap. No, I love that. And Derek, I thank you so much for coming on. Where can people best follow your work?
Oh, sure. You can at me, Derek Barrera. It's just my name. Very easy to find. And if you want to find our protocol, we're Steer Protocol at Steer Protocol on Twitter. Or at Steer Finance online. But I'd love to hear from you. Please check us out. Again, we're on just about any chain that you can think of in your head, hopefully. And if not, please let us know, and we'll come support that chain as soon as we can.
Well, thank you so much, Derek. And that's a wrap for another episode of the Ungovernable Podcast. Again, thank you so much, Derek, for sharing your insights. And for our listeners, don't forget to subscribe to us on Spotify and YouTube. We're dropping new episodes every single week. Be sure to follow us on X at Grow Uniswap to stay updated. This was another Ungovernable Podcast. I'm Austin, and see you next week.
This was the Ungovernable Podcast by Alpha Growth. Watch all our episodes on YouTube or Spotify or weekly live on X.